I think, when we look at the market response, I think the market response is pretty rational given the information that we received. I mean, I think the fact that we're going to see the snap election, I think we and most other people would expect the Conservatives to come back with a bigger majority, and I think that takes the pressure off the risk of the so-called cliff edge risk on March of 2019. So I think the fact that sterling was up and gilts underperformed is fine. I think we look at where markets are now, and I think we'd say there's probably two-way risk on sterling, and UK bond yields still look pretty low to us.
Let's have a look at the asset classes one by one, Mike. Let's kick things off with sterling. We saw that rally yesterday. Today, maybe a little bit of profit taking, but do you think that this rally in sterling is actually sustainable? Can it continue? Because I feel that, yes, domestically, the Conservatives may have a stronger position now after the snap election, but internationally, vis-a-vis the EU, nothing has changed when it comes to their negotiating position, has it?
No, that's right. I mean, all that's really happened is that Theresa May will give herself a bit more wiggle room with her domestic audience. The European Union stance is pretty clear. I think they want to go through the three stages: the bill, the future arrangements, and the transition. This does take the pressure off and I think it does lower the risk of a disruptive outcome. So I think there is good reason why sterling has popped up a little bit. When we look at sterling, there are good reasons for sterling to trade a little bit better if we get some more conciliatory signs. I think the key thing with us with sterling is that sterling is and continues to be one where there is two-way risk. You see sterling rallying on better days for the UK and selling off when life looks a bit trickier. So I think sterling to us is pretty decent two-way risk. I mean, 130, is fairly obviously a level the markets will look at versus the dollar, but two-way risk I think is the way we see it. We wouldn't argue for a big position one way or the other down here.
Okay, let's also talk about gilts and gilt yields. Usually they track an economic outlook. Once again, has the economic outlook for the UK fundamentally changed given the announcement yesterday?
Right, I think the tail risk of a bad economic outcome is probably a little bit lower. When we look at UK interest rates, the things that surprise us is how low intermediate rates are. We've got 10-year yields at 1%, base rates at 25 basis points. So it's a pretty flat curve. When you look at what's priced into the front end, I think the first rate hike is now priced for the second half of 2019. And the economy has been doing pretty well, even before this snap general election. I mean, our forecast is the economy is going to run around about 2% growth this year, so not radically different to most of the other major economies. And we just think that the risk profile of the gilt market is one in which a lot of bad news is priced in. You can look at that in various ways. The way we tend to look at it is versus US Treasuries, where the yield difference between the two is at a 20-year high. So we think UK rates look pretty rich to us, look pretty expensive, and we prefer to deploy our capital in the US rates markets rather than the UK.
I want to come back to sterling and what it means for inflation, because obviously we've seen a huge surge in UK inflation thanks to the plummeting pound. Do you think that now the BOE will rethink its tightening schedule as and when it comes because of the change in what pound sterling is doing?
I think at the moment, I don't think the move in sterling is enough to radically alter the bank's forecast. I mean, interesting enough, they actually have a lower peak on CPI than we do. We think the CPI could hit 3% by the turn of this year. Their peak is about 275. So I don't think this kind of move in sterling is something that would cause them to significantly reassess their forecast. And don't forget, some of this rise in CPI is going to be baked in the cake now. But there's typically a 12-month lag between import prices coming through in the CPI and the move in sterling. So a rise up in CPI is pretty much baked in the cake. I don't think the move in sterling so far would be a big game changer for the bank.